Hello and welcome to our lesson on financial instruments. So, a financial instrument is any contract that will give rise to a financial asset on one equity, on one entity, and a financial liability or equity instrument to another entity. So it's a contract that will give rise to a financial asset on one company and a financial liability or equity instrument in another entity. So let's give an example of how this would happen. Let's take an example of a bank loan. So company A borrows 1 million from bank B under a loan agreement, and this loan will be payable in 2 years with interest. Now let's look at a step-by-step analysis of that scenario. So company A has taken a loan from bank B. So in company A, they have an obligation to pay the loan. So we are going to classify that as a financial liability. And a financial liability is a contractual obligation to deliver cash. What about now in the books of Bank B? Bank B has the right to receive payment, and this will in turn be classified as a financial asset in the books of Bank B. So it will be a contractual right to receive cash. Company A will deliver the cash, and that will be an outflow of economic benefit, and that's why we are saying that is a financial liability. And company B will receive cash, that is an inflow of economic benefit, and that's why we are saying it's a financial asset. Let us now look at how we value financial assets. So, valuation of financial assets. Let us look at how we would value financial assets. So, valuation of financial assets. Financial assets can be valued into three, or classification can be classified into three categories, or we can value them based on these three categories. At cost, the first one will be at cost. We can also value them at fair value, through other comprehensive income, and lastly we can value them at fair value through P&L. Now, before we value this financial asset at cost, there are certain conditions we need to have met so that we can go ahead and conclude that these financial assets will be valued at cost. So, what are the conditions that must be met? That must be met so that we can value these financial assets at cost. The first condition is that this financial asset needs to be held to maturity. One, held to maturity. Must be held to maturity to collect contractual cash flows. It must be held to maturity to collect contractual cash flows. An example are those cash payments we will be receiving if we were the bank. must be held to maturity to collect contractual cash flows. Number 2, the second requirement that must be met is that the cash flows are for payment of interest and higher. So you can even say held to maturity. Number 2 must be held to collect cash flows. Must be held to collect cash flows. And number 3, we can even say that those cash flows are for payment of interest and payment of interest and principal. Are for the payment of interest and principal. That is, those are the two, can even say 3 conditions that must be met for us to classify or for us to value a financial asset at cost. It must be held up to maturity, and it's being held up to maturity so that it can collect contractual cash flows, and those contractual cash flows are for the payment of interest and principal. Let us look at the second classification, at fair value through other comprehensive incomes. At fair value through other comprehensive income. Now, this can either be a debt instrument or an equity instrument. It can either be a debt instrument or an equity instrument. Let me create some space here by maybe erasing some bits. So it can either be a debt instrument or an equity instrument. It can either be a debt instrument or an equity instrument. Now, certain conditions have to be met for us to value a debt instrument at fair value through other comprehensive income. For us to value a debt instrument at fair value through other comprehensive income, one of the requirements, one of the conditions that have to be met is that, one, it has to be held to collect contractual cash flows, must be held to collect contractual cash flows, and it must be sold before maturity, and must be sold before maturity. It must be sold before maturity. It is held to collect contractual cash flows, and it must be sold before maturity. That is one of the conditions. Another condition is that those contractual cash flows are for the payment of interest and principal. Payment of interest and principal. Those contractual cash flows are for the payment of interest and principal. Now, for us to classify, or for us to value an equity instrument at fair value through other comprehensive income, it must be for shares that are not for trading. These are shares, they must be shares that are not for trading. When I say shares that are not for trading, I mean shares that are held for long term. Shares that are held in the long term. Now, let us look at another valuation or another classification, or how we are supposed to measure financial asset at fair value through P&L. So for us to value a financial asset at fair value through profit and loss, that financial asset must be for any other financial asset that has not been mentioned in the other two classifications. So any other financial asset. Any other financial asset that has not been mentioned. E.g., an example, we have not mentioned shares for trading. For trading. We have not mentioned shares for trading. Now, that is how we would value a financial asset. Let us look at how we would measure a financial liability. So, a financial liability would be measured at amortized cost. A financial liability is measured at amortized cost. A financial liability is measured at amortized cost. That is why we prepare a loan amortization schedule for the company that has taken the loan. So let's go ahead and look at an example. Let's go ahead and look at an example. ABC Limited issued a 4% 20 million bond. The issue cost was 534,000. The bond was issued at a discount of 2.5%. The bond will be redeemed after 5 years and at a premium of 10%. The effective interest rate is 7%. You are required to prepare the financial extract of the the extracts of the financial statements for each of the 5 years. Let's go ahead and attempt that illustration. So we have the bond that was issued, the 20 million bond that was issued. Now, the first thing we are going to do, we are going to determine the fair value at initial recognition. Determine the fair value at initial recognition. That is the first thing we are going to do. We are going to determine the fair value at initial recognition. Going back, that bond is a 20 million shilling bond. So it's a 20 million shilling bond. That is the nominal value. So the nominal value is 20 million. The nominal value is 20 million. And it is issued at a 2.5% discount. So 2.5% discount. So discount at 2.5%. So that will be 2.5% of 20 million. That is giving me 500,000. It is issued at a discount. And then we have the issue cost. The issue cost is, we are told that the issue cost is 534,000. So The issue cost is 534,000. And now we can get the fair value. What I mean by fair value is the net proceeds we are going to receive if we issue the bond. Remember, we have issued the bond at a discount of 2.5%, and the issue cost is 534,000. So effectively, the fair value or the net proceeds we are going to receive, the net proceeds, or we can call it the fair value, will be 20 million minus 500,000 minus 534,000, which is giving me 18,966. With that, now I can go ahead and determine the amortized cost. Remember, on our earlier lesson, we said that a financial asset can be valued either at cost, at fair value through other comprehensive income, or at fair value through P&L. But when it comes to a financial liability, it is measured at amortized cost. It is measured at amortized cost. Now, going back to the question, we are told that ABC Limited issued a 4% 20 million bond, and the issue cost was 534. Immediately they issue out that bond, it becomes a liability to the company. So this is a financial liability and not a financial asset. This is a financial liability. That is why we are going to measure it at amortized cost. And when we are measuring it at amortized cost, then we prepare an amortization schedule. So let's go ahead and prepare our amortization schedule. So we have the year, we have the balance brought down, we have the finance cost, we have the cash paid, and the balance carried down. So we have year one. Year one, the balance brought down was 18,966,000. Those are the net proceeds. So 18, let me suspend 3 zeros, 18,966. 18,966. So the finance cost is at 7%. So 7% is the finance cost. So we take 7% of 18,966. That is giving me 1327.62. 1327.62. Let's go back to the question. We are told that it's a 4% 20 million bond. So each and every year they are supposed to pay 4% of 20 million. They issued a 4% 20 million. So 4% of 20 million is 800,000. So the cash paid will be 800,000. We now get the balance carried down. So the balance carried down, I'll take 18,966 plus 1327.62 minus 800,000, which will give me 493.62. 18,493.62. No, not 18 but 19. So the balance carried down for this year will be the balance brought down for the second year. So we start with 19,493.62. I take 7% of this one, 19,493.62 is giving me 1364.62. 5. We pay 800 shillings. I take 19493.62 plus 1364.55 minus 800, and that is giving me 20,058.17. We go to year 3. The balance carried down for year 3 will be, for year 2 will be the balance brought down for year 3. So 20,058.17. I take 7% of 20,058.17, and it is giving me 1404.07. Again, we pay 800. We are paying 800,000 each and every year, so we pay 800. So we have 20 plus 1404.07 minus 800, and that one is giving me 2662.24. Let's go ahead and do for the 4th year. For the 4th year, I'll take the balance carried down for year 3, so 2662.24. I take 7% of 2662.24. It's giving me 1446.36 minus 800,000. So I get 21,308.6. And lastly, I go to year 5. I have 21,308.6. Remember, this is a 5-year bond, and the bond will be paid out in year 5. So the finance cost will be 7% of 21,308.6, which is 1491.6. 1491.6. So we are going to pay out 800 again in year 5, and the 22 million. So if I take this plus this, should give me around 22 million. That is what we will be paying out in year 5, and we have no balance carried down in year 5. So let's go ahead and prepare the P&L extract. Go ahead and prepare the P&L extract. So we have P&L extract, profit and loss extract. Have the profit and loss extract. So we have the year, and I have in the profit and loss, we are only going to recognize this finance cost at 7%. This is what we are going to take to the P&L. So let's go ahead and record that one. So yeah, and we have the finance cost. Remember, finance cost is an expense, so we have year 1, year 2, year 3, year 4, year 5. So in year 1 we have 1327.62, 1327.62. We also have year 2 1364.55, 1364.55. Year 3 we have 1404.07, 1404.07. Year 4 we have 1446.36, 1446.36. And lastly, year 5 we have 1491.6, 21.6. That's it. Now that is the P&L extract. We go ahead and prepare the balance sheet extract. So the balance sheet extract. The balance sheet extract. So for the balance sheet extract, remember this is a liability. This is a liability. So we have year 1, the year. We have year 1, year 2, year 3, year 4, and year 5. So we will have the non-current liability section in our balance sheet. Non-current liabilities, abbreviated at NCL. So we have the 4% bond. It was a 4% bond, so 4% bond. And we also have current liabilities, again 4% bond. Remember, recall from our financial accounting that an non-current liability is that liability that will be paid out in more than 1 year. But a current liability is one that will be paid in less than 1 year. So if we go to year 1, back in our amortization schedule, if we go back to year 1, we can see that this amount will be paid out in more than 1 year. This amount will be paid out in more than 1 year because it will be paid out in year 5, same case to this one. But for this amount, it will be paid in the next year. It will be paid in the next year. So that will be a current liability and not an non-current liability. So let's go ahead and record that one. That for non-current liability, we have 19,493. We have 19,493. This one here, 19,493. Because it's being paid in a period of more than 1 year, 0.62. For year 2, the same thing. Year 2, the same thing. We have 20,058.17, 20,052, 20,058.17, because again, it's being paid in year 5. Let's go ahead and look at the second one is 2662.24. 2662.24. That again is being paid in a period of more than 1 year. But now the amount in year 4, the amount in year 4 is being paid in year 5, paid out in year 5. We are clearing this debt in year 5. So we will not recognize it as an non-current. That is a current liability. So this amount in year 4 will be a current liability. So current liability none. So but in year 4 we have 121,308.6, and we have no liability in year 5 as at the end of year 5 because we would have paid off the whole amount and our accounts will read no liability as at the end of the period. So that marks the end of our first lesson on financial instruments. On our next lesson, we will still look at financial instruments, but we will be focusing on compound financial instruments. So see you in the next lesson.